Welcome to HouseLux Estate, your reliable source for investment strategies and insights. We are your dedicated guide through the intricate world of financial markets and investments. Our mission? To empower you with the knowledge to make informed decisions and achieve your financial goals. Today, we're diving into a topic that's a game changer for many investors: top strategies for investing in low-cost index funds. Now, if you're wondering what low-cost index funds are, think of them as a type of mutual fund or exchange-traded fund, ETF, with a portfolio constructed to match or track the components of a financial market index. They provide broad market exposure, low operating expenses, and low portfolio turnover. These funds are a popular choice amongst investors for their affordability and potential for steady growth. Stay tuned to learn about the top strategies for investing in these remarkable financial instruments. Diving right in, let's talk about what low-cost index funds are. In the simplest terms, index funds are a type of mutual fund or exchange-traded fund, ETF, with a portfolio that aims to replicate the components of a market index. These could be widely recognized indexes like the S&P 500 or the Dow Jones Industrial Average. But what makes an index fund low-cost? Well, it's all about the fees. Low-cost index funds are designed to keep operating expenses and other fees minimal. They achieve this by adopting a passive management approach, which means the fund simply replicates the index it tracks without trying to outperform it. This lack of active management keeps costs down, hence the term low cost. Now, why are these low-cost index funds so popular among investors? There are a few reasons. First, they offer diversification. Since an index fund holds all or a representative sample of the securities in the index it tracks, you're essentially spreading your investment across a wide range of assets. This can help reduce risk. Second, the low fees are a big draw. The less you pay in fees, the more of your money stays invested and has the potential to grow. Over time, even a small difference in fees can have a significant impact on your returns. And third, the passive management approach of index funds is appealing to many investors. It means you don't have to worry about the fund manager making poor investment choices. The fund simply follows the index, which historically has tended to rise over the long term. In summary, low-cost index funds are a type of investment that aims to replicate the performance of a specific market index. They are popular for their diversification benefits, low fees, and passive management, making them an attractive option for many investors. Now that we understand the basics, it's time to explore the strategies for investing in low-cost index funds. The first strategy is to start early and invest regularly. It's all about capitalizing on the power of compound interest. Think of compound interest as a snowball rolling down a hill. As it rolls, it collects more snow, growing larger and faster. That's exactly how your investment grows over time. The earlier you start, the more time your investment has to grow, and the larger your snowball becomes. Now let's talk about regular investments. There's a strategy called dollar cost averaging. This involves investing a fixed amount at regular intervals, regardless of the price of the index fund. Doing this means you buy more shares when prices are low and fewer when prices are high. Over time, this can lower your average cost per share. Why does this matter? Well, it helps you mitigate market volatility. The market fluctuates, prices go up and down. But if you're investing regularly, you're not trying to time the market. You're not worried about buying at the perfect moment. You're just consistently adding to your investment. This combination of starting early and investing regularly isn't just about growing your wealth. It's about creating a habit, a discipline of investing. It's about looking at the long-term picture and understanding that in the world of index fund investing, patience truly is a virtue. This strategy is a proven method for long-term wealth accumulation. The second strategy is to diversify your portfolio. Now, what does that mean? It's like the old saying goes, don't put all your eggs in one basket. The same principle applies to investing. Diversification is about spreading your investments across a variety of different assets to minimize risk. Imagine you've invested all your money in technology sector index funds. If the tech sector takes a hit, your entire portfolio suffers. But if you diversify, investing in different index funds across various sectors and geographies, you're not as vulnerable to a single industry's downturn. Think about it this way. You're creating a financial ecosystem. Just as a healthy ecosystem thrives on biodiversity, a robust portfolio thrives on financial diversity. You want different types of assets from different sectors with different risk levels. Diversification also provides broad market exposure. You're not betting on one horse, you're betting on the entire race. This can lead to more consistent returns over time. If one sector is underperforming, another might be booming. This balancing act can help smooth out the bumps in the road. But remember, diversification isn't about blindly scattering your money across every available index fund. It's about thoughtful, strategic allocation. It's about understanding your financial goals, risk tolerance, and investment timeline, and balancing your portfolio accordingly. It's a delicate balancing act, and it requires regular review and adjustment. But when done right, it can be a powerful tool for managing risk and driving returns. Diversification is the key to balancing risk and return in your portfolio. The third strategy is to rebalance your portfolio regularly. Now, what does that mean? Picture a garden. You've got a variety of plants, right? Some grow faster than others, and if left unchecked, these fast growers could overshadow the others. So you prune them back to maintain the balance. This is similar to rebalancing your portfolio. When you invest, you decide on a specific asset allocation that suits your risk tolerance and financial goals. This could be a mix of stocks, bonds, and other asset classes. Over time, some investments may perform better than others, skewing your original allocation. Rebalancing is the process of realigning the proportions of your portfolio to maintain your desired level of risk. So, how often should you rebalance? There's no one-size-fits-all answer. Some investors check in quarterly, others semi-annually, and some only when the asset allocation deviates significantly from the target. The key is to have a disciplined approach and not let market fluctuations drive your decisions. Remember, rebalancing is not about chasing returns, but about sticking to your investment plan. When rebalancing, you might need to sell investments that are performing well and buy those that are lagging. While this might seem counterintuitive, it's all about maintaining the balance and sticking to your investment strategy. Regular rebalancing ensures that your portfolio stays aligned with your investment goals. It's like a compass, keeping your investment journey on track, ensuring you're headed in the right direction. The fourth and final strategy is to stay patient and disciplined. The investment world can be a roller coaster of ups and downs, and it's easy to get caught up in the excitement or fear of the moment. However, one must remember that investing in low-cost index funds is a long-term strategy. It isn't about timing the market or making quick profits. It's about building wealth over time. Patience is key. The market will have its ups and downs, but over time, the general trend has always been upward. It's important to resist the urge to react impulsively to short-term market fluctuations. Don't let a downturn scare you into selling or a surge entice you into buying more than you can afford. Discipline goes hand in hand with patience. It means sticking to your investment plan even when it's tempting to stray. It's about making regular investments regardless of what the market is doing. It's about not letting emotions guide your decisions and staying focused on your long-term goals. This strategy requires a calm and steady approach. It's about understanding that there will be good days and bad days in the market, but the overall trend is your friend. So keep your emotions in check, stay disciplined, and keep investing patiently. Remember, investing is a marathon, not a sprint. As we wrap up, let's quickly summarize the top strategies for investing in low-cost index funds. First, remember the importance of starting early and investing regularly. The magic of compound interest is your best friend here. Next, diversify your portfolio. Don't put all your eggs in one basket. A diversified portfolio can help you weather the storms of market volatility. Thirdly, make a habit of rebalancing your portfolio regularly. This ensures that your investment allocation aligns with your risk tolerance and investment goals. Lastly, stay patient and disciplined. Investing is a marathon, not a sprint. It's about the long-term game, not short-term gains. Don't let market fluctuations deter you from your investment plan. These strategies are not a guarantee of success, but they can certainly increase your chances of achieving your investment goals. Thank you for watching. Don't forget to subscribe to HouseLux Estate for more insightful content on investing. Until next time, happy investing.